Good afternoon, everybody, and welcome to the July 2023 third quarter global markets and economic update. As you can see, my name is Chris Rawson and my colleague Brian Bly. We're going to walk you through a number of charts and give you an update on the global economy, the US economy. We're going to dive in and talk about US equities, as well as international developed and emerging markets. From there, we'll talk about bonds, otherwise known as fixed income, talk about some concerns that we're aware of and as we all are, but didn't want to brush over any concerns that we are aware of. And then charts to remember, and we'll leave you with a couple of high points from there. So periodically, as we go through, I'll come back and reference this agenda. As you all know, we always have an agenda for all of our meetings, and this will continue on. We have a collaboration of a number of charts, a number of companies. Fidelity produces this business cycle, which we find very helpful. And so for the entire world, essentially, we are all in the late business cycle, and China is essentially coming out of their recession. The UK and the Eurozone are a little further ahead than the US in terms of their sort of slowdown and working through their business cycle. And then interestingly, and you'll see this throughout the charts, throughout the presentation, we have Japan and India and Mexico that are actually in quite a good position. Brian, let me, this one, I'm going to turn over to you.
So looking at global unemployment, all three, the US, China, and the Eurozone, US and China codependent there, or not codependent, coincide with one another, all are at 15-year lows over this period. Japan also remains very low as far as unemployment rates. So there's been no concerns from US nor from other developed markets, and as well as China, as far as the unemployment rate is concerned.
Is it letting you advance the slide?
No, it's not.
All right, I got that.
Yeah, okay, thank you, Chris. So from a global growth perspective, one of the things we take a look at is the Purchasing Managers Index, a PMI. Anything above 50, this baseline 50 mark is considered growth. Anything below is considered contraction. So see all of the zones, Europe, Japan, US, China, and Russia are considered in the growth area, with several of the areas actually having a little deceleration in the growth, which may be indicative of global economic conditions slowing down a bit. But meanwhile, we still are above the growth cycle. On the next chart is another representation, but one of the things I like to identify on here, this is another identification of the PMI, is the difference between manufacturing and services. So services can be considered things such as hotel, airfare, or things as simple as getting a haircut. So there still continues to be a dichotomy between services and manufacturing, where manufacturing is in kind of a declining cycle below 50, and services is above 50. As you can see here, now these June numbers are JP Morgan's forecast, but as you can see here, based on their forecast, as identified in the other chart, while many of the areas remain above 50, there is a bit of a deceleration in growth when compared to the previous month in May.
So I'm going to walk us through some components on global central banks. We hear a lot in the US about the Federal Reserve. The Federal Reserve had a meeting yesterday. They're meeting again today. We will find out if interest rates are going to rise again. The Federal Reserve meets every 6 weeks. So when you, on an annual basis, that's 10 times. And in the last meeting, they did not raise rates. We'll see what happens today. The thought from JP Morgan, for example, is that they skipped last time. They'll raise rates today or tomorrow by 0.25%. They'll skip again in the next 6 weeks, and then they may raise again when we get to November. So we'll see what happens. But this chart is showing us all the way back. We've been at this over a year. So here's the Federal Reserve routinely raising their interest rates. You have the Bank of England here in red. The Bank of England just raised their rates earlier this month in their cycle of the meeting. And then in blue, you have the European Central Bank. In the light blue down here, you have Japan. So Japan doesn't have as much inflation. And so they don't need to raise interest rates. And then China's here in, I don't know if that would be considered yellow or orange or what that color would be, but essentially they're lowering interest rates to drive and spur growth within their economy. And so the rising interest rates has lowered inflation. It has been working. The peak of inflation was June of last year. And so we've hosted this quarterly event a number of times now. And so the consumer price index this is a year-over-year chart, and these charts are from Schwab. And so what Brian did here was overlay what the numbers were from our last presentation. So the United Kingdom, even though their inflation year over year right now is 8.7, it was 10.4 3 months ago. And so what you'll notice is that, well, let me just come down to the US. So 3 months ago, we were at 6% annualized inflation. Now we're at 4%. So rising interest rates has worked. And every one of these numbers now on a year-over-year basis is lower than where it was even 3 months ago from a year-over-year basis. And so this last chart from JP Morgan gets a little bit more granular in the sense that they break it down quarterly. And so blue is good, red is bad. And you see the fading of some of that red and essentially giving you another indication that inflation globally is going down. Okay. This is the last piece that I wanted to highlight about this, which is that JP Morgan here is highlighting the forecast and what's expected in these dashes. And so the Bank of England and every single one of the developed markets banks are planning to continue to raise rates, even though inflation is going down, because they don't want it to sort of reignite, with the express intention of lowering interest rates into 2024 and beyond. So our Federal Reserve is here expecting 1 or 2 more rate hikes this year, and then declining rates from there. And then the same thing with the European Central Bank. Over time, for the Bank of Japan, the expectation is for them to start to raise interest rates because they're in a different place in the business cycle. Okay, Brian, let me turn this over to you.
So now we're switching from the global stage more to focus just on the US with these set of slides here. So as mentioned earlier, our employment rate is down here. This is in black. So we're down here at 3.7%, below even, I guess, the last 50 years, one of the lowest levels that we've had. On the wage front, we had seen some increasing wages throughout last year and into this, and started coming into this year, we've actually seen wage declines. So now our wage growth is at 5%. So as previously mentioned, referenced by Chris, while our inflation rate has come down from 6% to 4%, our wage is at 5%. So actually, from a real income perspective, we are now at least seeing wage increases that are higher than the recent inflation amount, but they are still coming down. So there's going to be less pressure as far as inflation and what producers, manufacturers and other folks that pay wages. It's not as much of a pressure on their bottom line now as it was here earlier, I guess, in 2021 as well as in 2022. Along those same lines, while unemployment remains low, we are still have over 10 million job openings. So as you can see, this number, while it's come down from the peak of 12 million openings in March 2022, we're still above the 10 million mark. So I think we have approximately about 2.5 jobs available with folks compared to folks looking for work. So we still have a very robust economy as far as job demand is concerned. And this is another indication of we're still adding jobs actually as well. So here's the non-farm payroll gains. These are the new jobs added. So as of last month, we're still up above the 300,000 level. So we are still adding jobs. And then also on the participation standpoint, in the age group of 25 to 54 years, which is reflected on this left scale here in the blue line, you can see our labor force participation rate continues to increase into this year. So even though we have a high number of jobs available, the number of available workers in the 25 to 54 range is continuing to decrease as far as participation. And then the 55 plus payroll participation rate, which is reflected on the right scale, continues to go down a tad bit.
So good. I guess I'll just highlight that this is one of the key highlights here, this 10 million number. We have over 10 million jobs available in this country. And if we look at the scale on the bottom, back to 1973, that's 50 years. In 50 years, we haven't had 10 million jobs available. So this is one of the key points that I want to, really highlight in our presentation today. Okay, now we're going to look at the growth of the U.S. That's represented by GDP, which stands for gross domestic production. And so here are the quarter over quarter numbers. We did see a negative number in the second quarter of 2022, and there were some reasons for that. And then it jumped up in the third quarter of last year. But what you see here is that these numbers are coming down a bit. So the year over year numbers you see is 1.8, 1.9. Then, you factor that in, you get a 0.9. And then at 1.8. So the year over year, well, it's about even minus this one anomaly, but this is something that Brian and I look at. And as we, of course, continue to host this event, we'll continue to highlight this for you. Over the last 20 plus years, the trend for growth in the US, gross domestic production, is 2%. Here you see COVID, where the whole world shut down, Then we rebounded. We got up to that 2% trend line, sort of fell off, and we're working back up towards that number. The US economy is largely driven by the consumer. So 2/3 of our economy is driven by the consumer. And this highlights what is the health of the consumer saving and borrowing. So this blue mound is household excess savings, which in this time frame from 2020 and beyond is COVID stimulus. So COVID came, the reaction, the policy was to send checks. Well, not realizing that all of our expenses had gone down. We weren't going anywhere. So what happened was that personal savings rate really jumped up. So there was at one point in time over $2 trillion in cash that people just had in their bank accounts that they didn't have any ability to spend. So they just naturally saved it. Well, as COVID has faded, this money is being spent. But this is also why we have inflation, is because, I mean, that's the definition of inflation, is more dollars chasing the same amount or fewer goods and services. So hence rising interest rates. And now this excess savings is being spent, but there's still cash left over. So excess savings is 0.4 trillion or $400 billion of cash that people still have in their bank accounts that they're inclined to spend because we were cooped up for 2 years. And so part of that reaction to COVID is that people are just simply not saving as much. So currently the savings rate for consumers is 4.3%. The historic average is just under 9. Even when you take out the 60s and 70s and 80s, the savings rate for the 5 years prior to COVID was about 7.6%. So even there, the savings rate is lower. And so the expectation is that as this cash starts to get spent and people hopefully, start to feel more normalized after they start to save more. But there is some additional headwinds for that younger group, I would likely say the 25 to 54 folks, specifically because of student loans. And this chart is showing student loan delinquencies. Student loans are going to begin to be due in October. The historic delinquencies for student loan debt was anywhere from, you could say, 7 to just under 12%. So this was the forbearance, and it's been at 1.1% because they hadn't had to pay. Well, we're aware of this, and we are expecting student loan delinquencies to rise because some people may just not manage well enough, even though they're being told their student loans are going to be due. But that's expected. So part of what we're presenting here with all this information are the highlights of where things are positive in the economy, but also letting you know that we are aware and don't gloss over the fact that there are concerns overall. And so this last chart here is household debt service ratio. So 9.7 is where it is now, which is, meaningfully lower than where things have been in the past. So even though there may be some concerns historically, they should be within range of what's historically normal. Okay, Brian, let me turn these over to you.
So we'll walk through a couple of charts here with inflation. So this is try to walk this through as best as possible. It's quite a little bit of busy of a chart, but basically this darker blue line here is what's considered headline inflation, and this lighter blue line here is core inflation, which includes food and energy. So one of the things I like to highlight that while energy was a key contributor to inflation throughout 2022. Starting here in 2023, as you can see here, inflation has actually, energy has actually been negative as far as the inflation rate is concerned. So that's been a subtractor from inflation, where it grew to be a key contributor to overall inflation as we went through 2022, as you all know. We'll see some more of those details here in the subsequent chart. As can be seen here, services, as mentioned before, this is once again, airfare, hotels, getting hair done. That still remains a large component of the inflation, whether you're talking about headline or core. One other thing is noted here is you can see this maroon line in rent. So COVID, rent went up, and now it has started to level off in 2023. So that's a good sign that, another further sign of the increase in central bank rate policy and them trying to tamper down overall inflation. And this will highlight a little of the factors again. So we looked at this before. So what I reflected in here is our charts last time is the February to February 22 to 23 view versus the current view. So as mentioned before, you can see natural gas declined year over year from May 22 to May 23, almost close to 12%. And then gasoline is close to 20%. So that's where you see the energy inflation or deflation impact over our overall inflation. Housing remains about equal compared to last time. Food has come down a bit. All items have come down a little bit. This is kind of a cumulative view of it. Hotels and motels, they've come down a little bit. They still have about 3.6, 3.7%. Used cars, once again, those are going down compared to the spike that we saw with the limited availability during COVID. Used car prices are still coming down year over year. And once again, even though airfare has come down from a May 2022, May 2023 by about 11.4% or 13.4%, taking into account that when folks were released and COVID started loosening up, airfares had increased over 25% when we took a last look at it between the February 22, 23. So while services inflation, services does affect inflation a lot bit. Even though we did have a decline, just taking into account that we had some super inflated air activity in the airfare area.
Mm-hmm. Yeah, good. And then this last one.
Okay, and here's a longer term view of inflation. So where we are here, just kind of historical view, you'll see peaks throughout. So the COVID surge, one important factor Chris alluded to before, with one of the reasons which may be driving the central banks towards the continued increase in rates, at least for the rest of this year, is they want to try to avoid the situation where you see some similarities here of where this in the 70s and the 80s, where inflation went up, rates were increased, brought it back down, but then it reemerged. So that's one of the things that, at least in our thought process, is what the central banks, our Fed, as well as other central bank Federal Reserves across the world, are trying to make sure to limit the possibility of this reemergence of inflation, which may which is kind of an indication of where, they may be increasing rates a few more times just to help prevent this from happening once again in the coming year or two for us.
Okay, so shifting gears now to the US and profit margins. These are the driving factors of the economy within the US. And so this chart from JP Morgan is highlighting the profit margins of the 500 largest companies in the US. On the bottom scale, we go all the way back to 1992. So 30 years of history, and these are the profit margins here on the left side. And so where we are right now, profit margins are at 11.6, which is quite good. Historically, for almost 30 years, they weren't at this mark, this percentage. Here's COVID. Here's the response to COVID. Okay, yes, profit margins have declined, but they're still very, very healthy. Part of the reason we highlight these numbers is because in our world now, the way that we receive messaging is, I consider it data mining, in the sense that they're pulling certain points and highlighting that to say, profit margins are going down. Well, going down from what? They're going down from a tremendously high number to, some number that's higher than they've been for more than, 20, 30 years. So I try to highlight these points and give you the why behind what we're doing, because part of our whole intention with hosting this event is to prepare you for some of those zingers that I think that we all get as we go through our day-to-day and month to month. Okay, so the S&P 500 has done well over the last 6 months and over the last 12 months because the end of last year was a good quarter as well. And so when I say it's done well, that's focused on the price. So PE stands for price divided by earnings. So if you have a higher price for the S&P 500 because the value's grown, that's great. And if you have higher earnings in the denominator, a bigger number there, that's going to actually lower the multiple. So that would be a good thing. What's happened so far this year is that the price has risen by a greater percentage than the equivalent earnings that we've seen. So we see here the average price to earnings ratio is just under 17%, or 17, I should say. And right now the number is 19. So we're in that area where prices have grown in a meaningful way. It doesn't automatically mean that the price will go down. We're seeing earnings this week. So you'll see earnings from the big tech companies, Google, which is Alphabet, Apple, Microsoft. They're all reporting their earnings. And a lot of what's driven this is the excitement around what the acronym you've heard is AI. So artificial intelligence is a big, exciting thing. And that's what's driven a lot of the price. And the expectation is that the earnings will be there to support the price as well. Okay, Brian, let me turn this over to you.
Yeah, so we'll shift over to the international front here. So as far as global earnings estimates are concerned, there's really no concerns. As far as the development markets are concerned, Japan, US, and Europe, we're all at relatively high levels compared to the last 20 years. So from an earnings perspective, has been no concerns or no signs of any concerns thus far. And most of them, while they've leveled off a little bit, they're still at relatively high levels. From a valuation standpoint, so as opposed to what we saw with the US, going back to global valuations, this is the PE that Chris referenced for domestic for US. The P levels for international developed markets, Japan and Europe, are below the historical average. So this purple line here is the 25-year average. The light blue diamond is the current PE level. So as you can see here, for both Japan and Europe, international developed markets, we are below the historical average from a price earnings perspective. So which is why we stay diversified, both with US and the developed market, international developed market, as well as an emerging market equities, is because valuation levels and pricing will change over time. So we want to make sure that we capture any benefits of that, regardless of what market it may be. And then you'll see here emerging markets, which is EM and China. Go back to the last page. Emerging markets. So emerging markets ex China is a little bit above the historical norm, but then when you look at China itself, the blue dot, the blue diamond, the current level is below the 25-year average. So overall, emerging markets as a whole is probably at or slightly below the 25-year average. And we've got for the more aggressive portfolios, we do have a small percentage allocated to emerging markets. Okay, Chris. So this is taking a look at our international valuations compared to the US. So as mentioned before, all the developed markets, less the US, we're at a mark that's below in this case here is 20-year average, where the US is above the 20-year average. So from a relative valuation perspective, international remains favorable to the US when looking at a historical perspective. And of course, it's been like that for, I guess, broke down through the average amount around, I guess, about 6 years ago. But we're at a close to over the last 2 years or so, we've been at a very low level with respect to valuations. So once again, that's one of the reasons why we've increased international a slight bit over the last several quarters, and we intend to remain there just based on a valuation factor.
Mm-hmm.
And then as well to kind of highlight kind of a little bit of lockstep, this is international dividend yields compared to dividend yields in the US. So on the opposite side, dividend yields in international markets, developed markets, are relative to the US are at a close to a high over the last 20 years. So we're right here right now at this level. And as far as your portfolios and what we hold for y'all, you'll notice that several of the international developed market funds do have that dividend tilt. So we're kind of taking advantage of this increased dividend yields relative to the US in these international markets, and having your money work in that area as well. Next slide, Chris. Chris? Okay, so Apologize for that. So it looks like Chris had a internet. So let me get caught up here. All right.
All right. Are we still,
Yeah. Are you able to see my screen, Chris?
yes,
All right.
so for everyone on the call, I did a Microsoft update yesterday morning. It completely disabled my ability to have the webcam and my speaker to work. So I powered up my oldest laptop that I was running, hoping that it wouldn't fail on me. And sure enough, the thing zonked out at minute 35. So Brian, thank you for being prepared, and we are still up and running. So
Good.
good that this
Oh,
was your part of the presentation. So let
yep.
me continue on
Okay.
here, let you continue, and then I'll jump in
All right. Okay. And,
as
and then
as we
this,
move on.
all right. So staying on the international front, this is the emerging markets view. So we've shown this slide for it's just really to point out the relative share of the world GDP of emerging markets compared to the US and then the international developed. So this is the reason why for many of the portfolios that we still have a portion of the amounts invested into emerging markets. And with that, we'll go ahead and Chris, if you can see my screen, we'll transition over to the fixed income piece of the presentation. Are you able to see this, Chris? We're not able to hear you, Chris.
How about now? But do you hear an echo?
Yeah, you're okay.
Okay, but you do not hear an echo?
No.
Okay. Okay. Now, the final part of it, not the final part, but the next sort of big component to share is the yield curve. So these are our bonds. The typical yield curve looks like this that you see from December 2021. So the shorter you are, so cash typically pays a lower rate, lower interest rate, and the longer the term, the more interest you collect. So a 3-year bond would typically pay more than a 3-month bond. Makes sense. Well, where things are now is a little different. So as most of you know, and this is the June 30th is in blue here, very short-term rates are paying more than even the longer term, the 3-year, 7-year, and 10-year rates. So, and this trend has been in place for a number of months now. And so by design, with your investments and your IRAs, we've migrated to this top left part of the yield curve because we can make more interest holding a CD on your behalf in your IRA and your investment account than you can holding a longer term bond. And so the next component I wanted to highlight is is interest rates. And so we try to avoid jargon, industry jargon. However, it's this term duration, I do think, is an important term for us to discuss. And so duration means the length of time. Think of it like a CD, a 3-year CD, a 5-year CD, a 10-year CD. So when you hear duration of 3, that means 3 years, or a duration of 5 means 5 years, which is the amount of time of the agreement to make the loan that you're making to a bank or a company or the US government, and the interest that you're collecting back. And so whatever your duration is, as interest rates are rising, so this is showing a 1% rise in interest. And when you have a seesaw, a 1% rise in interest, if you have a 3-year duration, you're going to see a 3% loss. And so people saw a lot of negative returns in bonds last year. And the more duration you have, as those interest rates rise, the more negative results that people saw in their portfolios. So over the last year, that's why we've had a very, very short duration. And as you saw on that yield chart above, we've been owning CDs because this is the best place for us to be. Part of our job working on your behalf is to think 2 to 3 chess moves ahead. And so we know that interest rates are going to rise likely over the next 6 months. We'll see what happens into 2024 and beyond, but we are expecting interest rates to decline. So now the opposite is working in our favor. So as interest rates are going down, we will see and expect to see positive results in your bond funds as a result. So one of the things that Brian and I are doing actively now in the background is talking about duration and adding to the duration in the portfolio, because we know as those interest rates decline, we want to be in a position to take advantage of those declining interest rates. And so if we go to the next slide, JP Morgan does a good job of showing you the difference between a 1% rise in rates in the gray bar and a 1% fall in rates in the blue bar. And so just taking the very bottom example, that leveraged loans, what you see, and so each of you own leveraged loans in your IRA, assuming you're not aggressive growth, because aggressive growth is all growth. But leveraged loans has a typical return of 8.7%, even in a rising rate environment. And then as interest rates go down, we see positive results. So this is giving you a view of what's going on in our minds and what are the conversations that Brian and I are having as we, like I said, work in the background and make decisions around how do we manage risk and take advantage of what we know is going to be happening in the future. Good. Okay, so now we're migrating into the next bullet point, which is concerns. So earlier this year, there were some meaningful concerns around banks. We saw one of the biggest bank failures in Silicon Valley Bank. There were some specific reasons for that bank failure, but there were also some what would otherwise be considered sort of, I don't want to say systemic, but like trends within smaller banks. So this bar in the middle here is showing you the smallest banks to the right. And when you look at their commercial real estate exposure, they have a 44% exposure in their loans to the commercial real estate. Looking on the left-hand side to the largest banks, they don't have nearly that exposure. So the smaller banks are a concern. And well, as Brian highlighted about inflation, you saw the rents were rising. So you may have read recently that in cities like Chicago and New York, they're actively trying to repurpose these office buildings to turn office space into residential space, and even providing tax incentives to do this so that there's a greater supply of apartments available, so that can further reduce the cost of the rent for people to, live and enjoy their time. So the smaller banks are a concern, and actually their inclination to lend. If they're less inclined to lend, that is a potential contributing factor to the growing economy. So it's something that we're aware of. It's something we're looking at, and as a result, something we're communicating with each of you.
Yeah, and once this is an updated view of our recession determinants. So as you can see back here during COVID, all of the key indicators, these 6 key indicators were all in the red. While recession has been talked about for months and months and several quarters now, based on all the key indicators, real personal income, as mentioned earlier, income wage growth is now higher than the inflation rate, so that's turning green. We've got some other positives. Non-farm payroll employment, it still remains in the light green. There's really no indication by at least these 6 key indicators that we're approaching or anywhere in a recession now. But this is something that we continue to monitor, like a lot of other factors. But there's at least no immediate concern outside of some extreme event that recession isn't like on anywhere on the near term immediate horizon. So all the number of these factors are still in the positive. And here's a little bit further insight into the last 6 months activities. You see 4 of the 6 are at a positive level. So we'll continue to monitor those and see, but right now there's no immediate indications of any type of recession. So now we'll transition to some of our key numbers, historical items to look at, and key charts to remember. So this is the daily volatility. So as any time there was a day of a greater than 1% move, so that could be a positive move or a negative on the downside move of the S&P 500. So last year, as everybody experienced, 122 days of the year. So how this affects you is like if you're looking at your account balances daily, your account balance may go down drastically or go up drastically. This is what you would see as far as your accounts or your portfolio value, depending on how much you got in equity. And that creates a nervous feeling. As you can see here in 23, while halfway through the year, we're still trending towards above the average. One thing I noted here is when we looked at this back previously in March, for the March number, the end of March number, we were at 29 days. And then subsequently this last quarter, April through the end of June, we've only had 12 days that have greater than 1% moves. So if you're looking at your account values, there's been less volatility, big changes as far as your account values concerned over this last 3 months, as opposed to what you might have seen first quarter of this year, or especially any time last year when this was the most volatile year, I guess, in the last 14 years from moves of greater than 1%. And Chris, did you want to go ahead and take this?
Okay, so this is a JP Morgan chart that for those of you who've worked with us for a number of years and attended these sessions are familiar with. And so the red dot, what this represents are the intra-year declines from any peak to any trough throughout the year. What is that range? And so what we know is that in any given year, we'll see some negative number. We don't know when it's going to happen, beginning, middle, or end, but we know there'll be some dips. But the other piece we know is if we didn't look at it at all, and except for 2 days a year, January 1st and December 31st, you would see this bar graph. So the vast majority of the time, roughly 75% of the time, 32 out of 43 years, you're going to see positive results. And periodically, about 25% of the time, we'll have a down year and it will end down, but a significant fraction less than when we end up ahead. And the next slide illustrates this well, which is from Fidelity. And so similar numbers in the sense that, but just sort of repackaged. And that's why we show you each. So the annual average return is 8% from, I think it's 1926 through the end of there it is, since 1926. And this is a compounding return, which is a very important difference between just simple. So 8% compound return. So what do we have to put up with that? Well, 3 corrections every single year of 5%, 1 correction on average every single year of 10%. Every 3 years, we need to put up with a 15% dip. And every 6 years, we need to put up with a greater than 20% dip. So that was 2022, where we saw a dip of 25%, and again ended 19. So last year, 2022 was, one of those years. And so, perfect. If we move on here, so what First Trust is also trying to do and sort of present to us is to say, okay, what percent of the time are we getting ahead? And what percent of the time are we losing money? And so what stands out to me, and I'll sort of like to draw your attention to, is this bar on the far right. So this represents a return of the S&P 500 of greater than 28%. And the fact is that this column has the most return years. So 2021, 2019, 2013. So there's more years here with a greater than 28% return than any other year. The second most frequent one is here, 14 to 21. The third most frequent one is actually here, 0 to 7%. And the fourth most frequent is now finally the negative one, -7 to 14. The emotional component is it's twice as painful to lose money than it is to make money. But the vast majority of the time we're in this positive side in these blue bars, if you will, but it's still quite painful. And there again, 2022 was just a tough year. It was a bad year, but this is meant to sort of give you that armor to prepare yourself as we go through the process.
And this is another chart from Schwab. So this emphasizes the importance of being in the market, being invested, than trying to market time. So this is what this does is takes a look at the last 20 years, 2003 through 2022 of the S&P 500. So here's the S&P 500 index performance, annual analyzed performance over that time period. If you were market timing or trying to market time and you missed the top 10 performing days of the S&P index, 10 days over this 20-year period, your annualized return would fall by nearly close to, not quite half, but from 9.8 to 5.6%. So by just missing 10 days out of this 20-year period, that's how much of an impact that those good days, those extremely good days, are on the overall performance. So that's one of the reasons we don't try to, put people in cash, bring them back to equities. We trying to time the market is just, professionals can't do it. So that's why we like to make sure that your portfolio, your money is working for you, you're invested for your risk, your growth profile. Taking a look a little bit further, expanding it out, if someone missed the top 20 days over this 10-year period, as you can see, the return is decreased by a factor of about 30%, going from 9.8% to 2.9. And then likewise, as you can follow through here, if you exclude the 30 days, the top 30 days, the return of the S&P is below 1%. And then if you were not invested, you were in cash for the top 40 days over this 20-year period, you actually would have a negative return as opposed to an almost 10% return over this period. So that's just really emphasis on the importance of why we keep your portfolios invested for your risk profile as opposed to trying to move around between cash and equities all the time. So it's just the importance of not missing the market, because one never knows when there may be a good day. And this just indicates, we talked a little bit about there's some signs of some slowing and all. It gives you an idea of a drop in, even though corporate earnings, like we're going through now, earnings periods, there may be some downside. This is the trailing year-over-year EPS, earnings per share. Even in the cases of decreasing earnings, corporate earnings over the S&P, does not translate into a year-over-year performance, a negative performance. So as you can see here on this left-hand side, there's very few years actually negative earnings performance results in a year-over-year price performance negative. So if and when we do come across those periods of negative earnings, don't automatically think that the stock returns relative to the previous year are going to be down. So Chris, you want to wrap up with some of our key points here?
So these are the key points that we want to share with you and leave with you. And so, we started with the agenda in terms of the high points. We highlighted a couple of points along the way, and now we want to end and leave you with these high points. The first of which is global unemployment is low, which is a very, very good thing, meaning most economies have a lot of people working and earning an income. This is also the reason why we continue to have these rising interest rates, but indirectly that's a positive. The US, and then there again, the demand for labor in the US is tremendous. There are over 10 million jobs available in the country, which we haven't seen in decades. And that was the highlight of that chart earlier in the presentation. Yes, we have rising interest rates. Global inflation is declining. It's moving in the right direction. And then the fourth point for the US is that, yes, we do expect another interest rate hike. We very well may see one this week, possibly pause in the next 6 weeks. And then when we get to November, wouldn't be surprised if we see another interest rate hike then, and then likely see a decline into 2024 and 2025. And we've also have those, like I said, 2 to 3 chess moves thinking ahead as part of our risk management strategy and investing philosophy as we work on your behalf in the background. So we've reached the end of our time today. If any of you have any particular questions as it relates to you personally, please feel free to reach out to Brian, reach out to myself. We'll answer those questions. We'll continue to host this quarterly event. So thank you for attending and the fact that you have registered, meaning that you'll get the reminders leading up to October. And Brian and I, on behalf of Brian and I, we're looking forward to continuing to work for you in a strong second half of 2023 and beyond. We have a very brief 5-question feedback at the end. Please give us your feedback. The feedback is designed to be brief, but also have an open-ended question at the end as to how we can improve. One of those is technology, so I'm going to get that fixed on my end. So thank you all for your patience as we had a bit of a technology issue here in the middle. But we are honored to work for you. On behalf of Brian and I, we love what we do. So thank you so much. Please give us your feedback and look forward to the second half of 2023 and beyond. Thank you so much. Bye-bye.